Before we begin, it's crucial to understand that I am not a financial advisor, and this video is for educational and informational purposes only. The content shared in this presentation does not constitute financial, legal, or tax advice. Trading cryptocurrencies, especially day trading, involves a very high degree of risk and is not suitable for all investors. You should consult with a qualified professional before making any financial decisions. Your capital is at risk and you could lose more than your initial investment. 97%. Let that number sink in. According to multiple studies on trader profitability, a staggering 97% of day traders consistently lose money. They end up with less than they started with. And that's in the traditional stock market. When you take that same high-risk behavior and drop it into the unregulated 24/7 seizure-inducing chaos of the cryptocurrency market, that number gets even more brutal. Yet, if you scroll through TikTok or Instagram right now, you'll be flooded with videos of 20-year-olds in rented Lamborghinis telling you they cracked the code. They'll sell you a course, a Discord signal group, or a magic indicator that promises to make you a crypto millionaire overnight. They are lying to you. They are selling you a fantasy while conveniently leaving out the soul-crushing reality. And for those of us trading here in the United States, that reality is a minefield of unique risks that can wipe you out faster than a Bitcoin flash crash. This isn't just about picking the right coin or timing the market. This is about surviving a system that feels, at times, specifically designed to make you fail. So this isn't another video showing you how to draw lines on a chart. This is your survival guide. This is the video that tells you what the gurus won't. We're going to pull back the curtain on the 3 great filters that are specifically designed to knock US-based crypto day traders out of the game: the taxman, the regulators, and the platforms. By the end of this, you will understand the real battlefield you're stepping onto, not the sanitized version you see on social media. You'll know the traps before you step in them. Let's start with the biggest, most misunderstood dream killer of them all: the Internal Revenue Service, the IRS. For a US crypto day trader, the IRS is not just an afterthought. It is an active, ever-present opponent in every single trade you make. You see, in the United States, the IRS classifies cryptocurrency not as currency but as property. This is the single most important sentence you need to understand. Because it's property, every time you sell or trade one crypto for another, it's a taxable event. Every single time. You bought Bitcoin and it went up? Great. You sell it for US dollars. That's a taxable event. You trade that Bitcoin for some Ethereum? Taxable event. You swap that Ethereum for a new altcoin on a decentralized exchange? Taxable event. You use that crypto to buy a pizza? Believe it or not, taxable event. The system treats it as if you sold the crypto for cash and then used that cash to buy the pizza. Now, here's where the nightmare truly begins for a day trader. Because you're trading frequently, all your gains will almost certainly be classified as short-term capital gains. Forget the favorable long-term capital gains rates you hear about for investors who hold for over a year. Short-term gains are taxed at your ordinary income tax rate, the exact same rate as the salary from your 9-to-5 job. So if you're in the 24% federal tax bracket, you can immediately slice 24 cents off every dollar of profit you make and hand it straight to Uncle Sam. And that's before we even talk about state taxes, which can push that number well over 30% or even 40% depending on where you live. Suddenly, your profit calculations get a lot more complicated. That 10% gain you just made on a trade? It's actually closer to a 6% or 7% gain after the taxman takes his cut. This means you need to win bigger and more often just to break even with the government. But it gets so much worse. Let's talk about the financial buzzsaw known as the wash sale rule. In the stock market, the wash sale rule is a law designed to stop investors from selling a stock at a loss to get a tax deduction, and then immediately buying it back. The rule says if you sell a stock at a loss and buy it, or a substantially identical one, back within 30 days, you can't claim that loss on your taxes for that period. Now, for years, the crypto world has lived in a gray area. The rule specifically mentioned stocks and securities, so many believed it didn't apply to crypto, which is classified as property. This loophole allowed crypto traders to do something called tax loss harvesting on an insane level, selling at a loss and buying back instantly to rack up huge paper losses to offset their gains. Well, the party is over. The US government is actively closing this loophole. The language is being updated, and the IRS is making it crystal clear. They want this to apply to crypto. So what does this mean for you, the day trader? It means you are walking into a catastrophic tax trap. Let me paint you a picture. Let's call our trader Alex. Alex starts the year with $10,000. He's day trading Solana. On Monday, he buys $10,000 worth. The market dips and he panics, selling it all for $9,000. He's taken a $1,000 loss. But Alex is a day trader. He believes in the coin, so just minutes later, he buys back in with his remaining $9,000. The market rips back up, and by the end of the day, his position is worth $11,000. He sells. So let's do the math. Alex started with $10,000. He ended the day with $11,000. He made a $1,000 profit, right? He's feeling pretty good. But now let's look at it through the eyes of the IRS with the wash sale rule applied. That first trade, the one where he lost $1,000, the IRS says, "Sorry, Alex. You bought back in within 30 days. That $1,000 loss is disallowed. You can't deduct it." But that second trade, the one where he went from $9,000 to $11,000, the IRS says, $2,000 gain. Congratulations. That is fully taxable as short-term capital gains. Do you see what just happened? Alex thinks he made $1,000, but on his tax return, he has to report a $2,000 gain. If he's in a combined 30% federal and state tax bracket, he owes $600 in taxes on a day. He only actually profited $1,000. His real take-home profit is just $400. His effective tax rate on his real profit wasn't 30%, it was 60%. Now imagine this happening hundreds or even thousands of times a year. You are constantly buying and selling the same coins, taking small losses, then getting back in. You could end a year where you barely broke even. Maybe you started with $10,000 and ended with $10,500, but because of all your disallowed losses and recognized gains, the IRS says you have $50,000 in taxable income. You could literally owe more in taxes than you have in your entire trading account. People have had their lives ruined by this. They end the year with a small profit or even a loss, only to get a tax bill for tens of thousands of dollars they simply do not have. And how do you even keep track of it all? Every single trade across every single exchange, both centralized and decentralized, has to be meticulously recorded. The date, the time, the cost basis, the sale price, the fees paid. It's an accounting nightmare of epic proportions. The crypto exchanges are notoriously bad at providing clean, easy-to-use tax forms like a traditional stock brokerage. The Form 1099s they send are often incomplete, inaccurate, or just cover a fraction of your activity. This puts the burden entirely on you to use third-party software, which can cost hundreds of dollars a year, to piece together your transaction history. And if you make a mistake, if you get audited, the penalties and interest can be devastating. This is the hidden reality of being a crypto day trader in the USA. Before you even learn a single thing about technical analysis or market sentiment, you are in a war against a complex and punitive tax code. The odds are already stacked against you, and this is just the first boss fight. Because even if you manage to master the tax code and keep perfect records, there's another, more unpredictable threat looming, one that can shut down your entire operation in the blink of an eye. That's the ever-watchful eye of the US regulators. And this regulatory environment isn't a simple rulebook you can study and master. It's a chaotic three-headed monster, where each head has a different opinion, and they're all screaming at you at once. Imagine you're playing a high-stakes game of chess, but the rules change mid-move, and 3 different referees can declare you in violation for the exact same play. That is day trading crypto in the United States. The core of this problem is a simple, unanswered question. What is a cryptocurrency? The answer, terrifyingly, depends on which federal agency you ask. This is the great American regulatory paradox. First, you have the Securities and Exchange Commission, the SEC. Headed by Gary Gensler, the SEC views almost every crypto asset, with the possible exception of Bitcoin, as a security. A security is a financial instrument like a stock or a bond. If you buy a share of Apple, you're buying a security. The SEC's job is to regulate these, and they have a mountain of laws like the Securities Act of 1933 designed to protect investors. The problem is, these laws were written for Wall Street, not for decentralized networks. To the SEC, when you buy some obscure altcoin, you're not just buying code, you're likely participating in an unregistered securities offering. The project's team is the issuer, and you, the trader, are the investor. This has catastrophic implications. It means the projects you're trading could be illegal. It means the exchanges listing them could be operating as unregistered securities exchanges. And it means you, the trader, are trading in a market the SEC considers fundamentally illicit. The SEC's strategy isn't to create clear rules for everyone to follow. No, that would be too simple. Their strategy is called regulation by enforcement. They don't tell you the speed limit. They just mail you a $1,000 ticket after you've already been caught speeding. They wait for a project or an exchange to become successful, and then they sue them into oblivion, claiming the token they offered was a security all along. Think about the position this puts you in as a day trader. You do your research, you find a promising new project, you buy its token. A year later, the SEC sues the project. The token's value plummets 99% overnight. You get wiped out. You followed all the market rules, you analyzed the charts perfectly, but you lost everything because of a legal decision you had no way of predicting. You weren't just trading against the market. You were unknowingly trading against the full might of the US government. But hold on, it gets more complicated. Because while the SEC is screaming, it's a security. Another powerful agency, the Commodity Futures Trading Commission, or CFTC, is screaming back, no, it's a commodity. A commodity is a basic good like gold, oil, or wheat. The CFTC regulates markets for these goods. They've stated that major cryptocurrencies like Bitcoin and Ethereum are commodities. So which is it? Is Ethereum a security like a stock in a company, as the SEC implies? Or is it a commodity like digital gold, as the CFTC has stated? The answer is yes. It's both and it's neither. It's Schrödinger's asset. It exists in a state of quantum uncertainty until a regulator opens the box. And by then, it's too late for the trader who bet on the wrong outcome. This isn't just academic. It's a turf war between two of the most powerful financial regulators on the planet, and every single crypto day trader in the US is caught in the crossfire. The rules for trading securities are vastly different from the rules for trading commodities. The protections are different. The legal liabilities are different. Operating in a world where an asset can be reclassified on a whim is like building a house on a seismic fault line. You might be fine for a while, but you live in constant fear of the ground beneath you splitting in two. And just when you think you've wrapped your head around that impossible duality, the third head of the monster appears. This is the Financial Crimes Enforcement Network, or FinCEN. FinCEN doesn't care if crypto is a security or a commodity. They care about one thing: money laundering. Under the Bank Secrecy Act, financial institutions, which now includes crypto exchanges, have a legal duty to monitor your transactions for suspicious activity. They are the government's financial spies, and you are their primary target. What do they consider suspicious? Well, the list is long, vague, and secret. Making frequent trades? That could be a flag. Moving large sums of money from a private wallet to an exchange? Flag. Receiving crypto from a mixing service that enhances privacy? A massive red flag. When your account gets flagged, the consequences are immediate and brutal. The exchange can and will freeze your account instantly. No warning. Your funds, your entire trading portfolio, are locked. You can't buy, you can't sell, you can't withdraw. You are completely paralyzed. And getting it unfrozen is a bureaucratic nightmare. You'll be asked to provide proof of income, source of funds, a detailed history of every transaction you've ever made. You're guilty until proven innocent, and the process can take weeks, months, or in some cases forever. Imagine you're in the middle of a critical trade. The market is pumping, you're up 50%, and you go to sell. Access denied. Your account is frozen. You watch helplessly as your profits evaporate. As the market turns, as your position goes from green to deep catastrophic red. All because an algorithm, programmed with secret rules you'll never see, decided your trading pattern looked suspicious. This isn't a rare occurrence. Go to any crypto forum, any Reddit thread, and you will find hundreds of horror stories of traders whose accounts were frozen by major US exchanges with little explanation and even less recourse. They played by the rules, they paid their taxes, but they were shut down because their legitimate trading activity looked too much like a criminal's. So let's put this all together. As a US day trader, you are legally required to pay complex taxes on an asset class the IRS barely understands. You are trading assets that the SEC might retroactively declare illegal securities, wiping out your investment without warning. You are operating in a market where the two main financial regulators are in a public, high-stakes turf war over the fundamental definition of what you're even trading. And all the while, every move you make is being monitored by a financial surveillance system that can freeze your entire livelihood in a nanosecond based on a secret algorithm. This is the reality they don't show you in the get-rich-quick TikToks. This is the brutal, invisible architecture of risk that underpins every single click you make. You're not just fighting market volatility. You're fighting the IRS, the SEC, the CFTC, and FinCEN simultaneously. And even if you manage to navigate this impossible maze, even if you pay every dime of tax, perfectly dodge every regulatory landmine, and keep your accounts in pristine standing, you could still lose every single penny in an instant. Because the greatest danger isn't the government you can see. It's the catastrophic single point of failure that you blindly trust every single day. The exchange that holds your keys and holds your future. Think of the crypto exchange you use as your bank. You deposit your hard-earned money, you see a balance on the screen, and you trust that when you want to withdraw it, it'll be there. But this isn't a bank. There is no FDIC insurance. There is no government backstop. This is a private, often unregulated technology company, and what you see on the screen isn't your money. It's an IOU. It's a promise. And in the world of crypto, promises are broken with terrifying regularity. When you buy Bitcoin or Ethereum on a centralized exchange, you are not the owner. You might feel like the owner. The app tells you you're the owner, but you don't actually hold the asset. The exchange does. They hold it in what are called omnibus wallets, massive digital vaults containing the mixed-together funds of millions of users. You are just a name in their private database with a number next to it. You have given up custody of your asset for the convenience of trading. You have handed the keys to your financial future to a stranger, and you are betting your entire net worth that this stranger is honest, competent, and solvent. This is the fatal flaw, the original sin of centralized crypto trading. And if you think this is just theoretical fear-mongering, let me take you back to the early days, to a name that still sends a shiver down the spine of any crypto veteran, Mt. Gox. In early 2014, Mt. Gox wasn't just an exchange, it was the exchange. Based in Tokyo, it was a titan, handling over 70% of all Bitcoin transactions worldwide. It was the bedrock of the ecosystem. If you were into Bitcoin, you were on Mt. Gox. And then the problems started. Small at first. Users reported delays in withdrawing their Bitcoin. The company blamed a bug in the Bitcoin protocol itself, a technical issue they called transaction malleability. They assured everyone they were working on a fix. It was just growing pains, they said. The price of Bitcoin wobbled, but most people held on, trusting the biggest player in the game. Then on February 7, 2014, all withdrawals stopped. A few weeks later, the CEO resigned from the Bitcoin Foundation board. And then silence. The website went blank. The office was empty. It was as if the entire company had vanished into thin air. And with it, 850,000 Bitcoin belonging to its customers. At the time, it was worth about $450 million. Today, that's over $50 billion. Gone. Life savings vanished. Early believers who had weathered incredible volatility to see their small investments turn into fortunes were wiped out. Not by a bad trade, not by a market crash, but by the catastrophic failure of the platform they were told to trust. They never held their keys, and in the end it turned out they never had their crypto. You might be thinking, that was the Wild West. That was a decade ago. Things are different now. We have regulated, US-based companies. We have celebrities and Super Bowl ads. And that's exactly what millions of people thought when they signed up for FTX. FTX was the golden child, the crypto darling. Its founder, Sam Bankman-Fried, was on the cover of Forbes and Fortune, hailed as the next JP Morgan. He was testifying before Congress, rubbing shoulders with presidents and prime ministers, shaping the very regulations that were supposed to keep customers safe. FTX had Tom Brady, Steph Curry, and Larry David telling you it was the safe, smart, and secure place to trade. They bought the naming rights to the Miami Heat's basketball arena. They projected an aura of absolute, unshakable legitimacy. And in November of 2022, the entire house of cards collapsed in less than a week. It started with the leaked report that suggested their finances were built on a foundation of sand. A rival exchange announced they were selling their holdings of FTX's native token, FTT. It triggered a panic, a classic bank run. Everyone rushed to pull their money out at once. But the money wasn't there. FTX halted withdrawals, trapping billions of dollars of customer funds. The truth that came out was far uglier than Mt. Gox. This wasn't a hack. This was, allegedly, one of the largest financial frauds in American history. Customer funds, your money, my money, were allegedly being funneled through a secret backdoor to a sister hedge fund, Alameda Research. They were using customer deposits as their own personal piggy bank to make incredibly risky bets, donate to political campaigns, and buy luxury real estate in the Bahamas. When their bets went bad, the hole became too big to hide. They were gambling with your money and they lost. Billions of dollars gone. Not in a hack, but siphoned away by the very people who promised you your funds were safe. The FTX collapse proved that no amount of marketing, celebrity endorsements, or political connections can protect you. As a day trader, this risk is magnified 100 times over. You can't day trade from a secure offline hardware wallet. You must keep your capital on the exchange to execute trades quickly. This means that every single second your money is sitting there, you are not just exposed to market risk. You are exposed to catastrophic counterparty risk. You are making an active, ongoing bet on the solvency and ethical integrity of the exchange's executives. It is a hidden risk baked into every single trade you make. A risk that has absolutely no upside. And total collapse isn't even the most common danger. The more insidious risks are the ones that happen every day. Ever wonder why exchanges seem to go down for unscheduled maintenance at the exact moment the market is crashing or pumping? When volatility is at its peak and you desperately need to close a position or take profit, you frantically hit refresh, but the login screen won't load. You're locked out, forced to watch as your account balance gets decimated, powerless to do anything about it. Is it a genuine technical overload? Or is the exchange protecting its own liquidity at your expense? You will never know for sure. Then there are the flash crashes. On an illiquid exchange, a single large market order can create a massive instantaneous price wick that liquidates every leveraged trader in its path before snapping back to normal. Your stop loss might not even trigger. You're just wiped out by a glitch that only seemed to happen on your platform. The most terrifying sign of all is the withdrawal halt. It's the canary in the coal mine. An exchange suddenly announces they are pausing withdrawals to protect users or upgrade systems. This is almost always the beginning of the end. Celsius did it. Voyager did it. FTX did it. It's the moment the music stops, and they lock the door so no one can escape with their money. By the time you hear those words, it's already too late. So you're trading on a foundation of quicksand. The very platform you rely on could be your greatest enemy, capable of imploding from fraud, incompetence, or a simple hack. It can lock you out at the worst possible moments and is under no real obligation to make you whole. So if the ground beneath your feet is this unstable, how can you possibly build a profitable trading career? How do you defend against a threat you can't control? It's not about avoiding exchanges entirely. That's impossible for a trader. It's about understanding the game you're really playing. Because the exchange isn't the only one with a hidden agenda. The very market itself is structured to exploit your psychology, to prey on your greed and fear, through a brutal, unforgiving mechanism that separates beginners from their money with ruthless efficiency. This mechanism is called the order book, and it is the single most misunderstood and most manipulated tool in all of crypto trading. To the untrained eye, it looks like a simple list. A column of green numbers on one side, representing people who want to buy. A column of red numbers on the other for people who want to sell. It seems like a transparent democratic marketplace. It is anything but. The order book is a battlefield. And on this battlefield, you are not just an infantry soldier. You are the ammunition. To understand why, you have to meet the generals of this war, the entities that truly control the flow of battle. They're called market makers. In the US, these are often massive high-frequency trading firms with names you've never heard of, like Jump Trading or Jane Street. They are sophisticated, multi-billion-dollar operations, and their entire business model is built on one simple principle. You, the retail day trader, must lose. Not because they hate you. You're not even a person to them. You are a statistical probability. You are a resource to be harvested. Here's how they do it. Market makers are given a special role by the exchanges. Their official job is to provide liquidity. That's a fancy way of saying they make sure there's always someone to buy from and someone to sell to. If you want to buy one Bitcoin right now, you don't have to wait for some other random person in Ohio to decide to sell their one Bitcoin at that exact second. A market maker will sell it to you instantly. If you want to sell, they'll buy it from you instantly. Sounds helpful, right? But this service comes at a price, a hidden tax on every single transaction you make. It's called the spread. Look at any crypto price. You'll see two numbers, a bid price and an ask price. The ask is the price you can buy at, and the bid is the price you can sell at. The ask is always slightly higher than the bid. That tiny difference, that fraction of a cent, is the market maker's guaranteed profit. They buy from sellers at the lower bid price and sell to buyers at the higher ask price, millions of times a second. It might seem insignificant, but when you're trading billions of dollars a day, those fractions of a penny add up to a fortune. Every time you click buy or sell, you are paying this tax. It's the cost of admission to their casino, and it's a fee that ensures they are profitable on a macro scale, regardless of whether the market goes up or down. You have to overcome their built-in advantage on every single trade just to break even, before you even think about making a profit. But that's just the beginning. That's their bread and butter. The real psychological warfare, the part that truly demolishes beginners, is how they actively manipulate the order book to engineer your emotions. They are masters of illusion. Have you ever looked at the order book and seen a massive buy order, a giant wall of money sitting just below the current price? You think to yourself, wow, that's incredible support. The price can't possibly fall below that. There are millions of dollars ready to buy right there. This is a safe place to enter a trade. So you buy, feeling confident. The price inches up a bit and you feel like a genius. But then, as the price starts to pull back and gets closer and closer to that giant wall of support, poof, the order vanishes. It was never real. It was a tactic called spoofing, placing a huge order with zero intention of ever letting it get filled. It was a phantom wall designed for one purpose: to trick you and thousands of others into feeling a false sense of security, to lure you into a trade. Once you're in, the wall disappears, the floor gives out, and the price plummets. The market makers who created the illusion now step in and buy your panic, selling at a much lower price. They played you like a fiddle. They do the same thing on the sell side, creating massive, intimidating sell walls to make you think the price can't possibly go higher. This creates fear and pressure, convincing you to sell your position early, right before they pull the fake wall, and let the price explode upwards without you. They are manufacturing FOMO and manufacturing panic, and they use the order book as their stage. But their most brutal, most infamous tactic is something traders call stop-loss hunting. When you place a stop-loss order, which every trading guru tells you to do, you're telling the exchange, if the price drops to this specific level, sell my position automatically to limit my losses. Supposed to be your safety net. But on an exchange, that safety net is a bright red flag for the predators. The market makers and the exchanges themselves can see where large clusters of stop-loss orders are sitting. They see it as a giant pool of liquidity, a pool of guaranteed sellers. Let's say a coin is trading at $10. The market makers see a massive cluster of stop-loss orders from retail traders sitting at $9.50. They know that if they can just push the price down to that level, they can trigger a chain reaction. So their algorithms go to work. They begin to systematically push the price down, selling into their own buy orders, creating a wave of downward pressure. It doesn't have to be a real market shift. It just has to be enough to trip the wire. The price touches $9.50. Suddenly, a flood of automatic sell orders hits the market as thousands of stop losses are triggered at once. This cascade of selling drives the price down even further to $9.49.30. And who is there, waiting with open arms to absorb all that panic selling? The same market makers who started the cascade. They scoop up all the coins from the liquidated traders at a massive discount. And then, once the hunt is over and the liquidity has been harvested, they let the price drift right back up to $10 or even higher. If you've ever had a trade where the price wicked down, hit your stop loss to the exact penny, and then immediately reversed and shot up to what would have been your profit target, you were not just unlucky. You were hunted. Your safety net was used as a target. You weren't trading against the market. You were the fuel for the market maker's engine. This is the game you're entering. You, with your one monitor and your Robinhood account, are facing off against billion-dollar quantitative trading firms with server racks located in the same building as the exchange's servers to get a microsecond speed advantage. They run on algorithms that can analyze and react to data faster than the human brain can even process a single thought. They don't feel greed. They don't feel fear. They simply execute a brutally efficient strategy designed to transfer wealth from the impatient and uninformed to them. You are not their opponent. You are their ecosystem. You are the plankton and they are the whales. Realizing this is a terrifying but necessary first step. It's the moment you stop seeing the market as a place to magically print money and start seeing it for what it is. One of the most hostile and predatory environments ever created by humankind. The exchange is the house, the market makers are the dealers, and they have structured the entire game to ensure they have an edge. But even they are just exploiting a weakness that already exists. They are leveraging a vulnerability that is hardwired into every single one of us. Because the greatest enemy you will face in this arena isn't a high-frequency trading algorithm. It's the 3 pounds of gray matter between your own ears. Let's talk about that brain. It's an incredible survival machine, honed over 200,000 years to keep you alive on the plains of the Serengeti. It's a master at pattern recognition, threat detection, and social cooperation. The problem is, none of those skills were developed for a world of leveraged crypto derivatives and sub-second price fluctuations. In fact, the very instincts that kept your ancestors from becoming a lion's lunch are the exact same instincts that will get you financially devoured in these markets. Your brain is running on ancient software in a hypermodern environment. When you see a chart suddenly spike upwards with a massive green candle, your primitive brain doesn't see a potential bull trap or an overextended asset. It sees the rest of the tribe running towards a fruit tree. It screams, "Go! Get it! Don't get left behind! Everyone else is eating, you're going to starve." This is the raw neurological root of FOMO, the fear of missing out. It's not just a feeling. It's a deep-seated survival instinct. You see a coin up 40% in an hour. Your palms get sweaty. Your heart rate quickens. You forget your entire trading plan, your rules, your research. All that matters is getting in. You slam the market buy button, paying whatever the price is just to be a part of the action. And in that moment, you feel a sense of relief. You're in. You're with the herd. But what you don't realize is that you just bought the bags from the professional trader who started that rumor, who bought in days ago, and whose sell order was just filled by your frantic purchase. You didn't join the party. You arrived just in time to pay for it and clean up the mess. You have just become what they call exit liquidity. Now let's flip the coin. Let's say you make a trade, and it immediately goes against you. It drops 5%. Your predetermined stop loss, the safety net you so carefully planned, is triggered. The rational part of your brain says, exit the position. Stick to the plan. A small loss is a good loss. But another, much more powerful force takes over. Loss aversion. Behavioral economists have proven that the psychological pain of losing $1 is twice as powerful as the pleasure of gaining $1. So when you're faced with crystallizing a loss, making it real by clicking that sell button, your brain rebels. It screams, and no, don't accept defeat. Just hold on, it will come back. So you hold. The position drops 10%. Now the pain is even greater. The thought of selling and accepting a 10% loss is unbearable. You start to bargain with the market. Please just get back to where I bought in just to break even, and I swear I'll sell. This is the sunk cost fallacy kicking in. You've already lost so much, you feel like you have to stay in to get it back. But the market doesn't know you exist. It doesn't care about your break-even point. It continues to drop. 20%, 30%, 50%. What started as a small, manageable paper cut of a loss, a disciplined part of a healthy trading strategy, has now become a gaping, hemorrhaging wound that threatens your entire account. You were so terrified of the small pain of a 5% loss that you embraced the catastrophic pain of a 50% loss. Hope is a beautiful human emotion, but in the world of day trading, it is the most expensive liability you can have. While you're holding on to this losing trade, another cognitive demon comes knocking: confirmation bias. You desperately want to believe the trade will turn around. So what do? You go looking for evidence that confirms your belief. You scroll through crypto Twitter, ignoring the 100-post warning of a market downturn. But you find that one anonymous account with a cartoon avatar that posts a rocket emoji and says, "Diamond hands. We're going to the moon." And you latch onto it. You feel a wave of validation. See, you tell yourself, I'm not an idiot. This guy gets it. It's just market manipulation. The smart money is holding. You go on YouTube and you don't click on the video titled, "Why this coin is crashing." You click on the one titled "Urgent." The massive breakout is imminent. You are not analyzing the market. You are building a psychological fortress of delusion to protect your ego from the fact that you made a mistake. A professional trader does the opposite. They actively seek out dissenting opinions. They ask themselves, what is the argument against my position? Why might I be wrong? They test their thesis for weaknesses. The beginner builds an echo chamber. The pro builds a war room. Let's say you survive all that. Let's say you get lucky. You have a few winning trades in a row. You hit a 10% gain, then a 15% gain, then a 20% gain. You start to feel it, don't you? That warmth in your chest. The feeling of invincibility. You're not just getting lucky. You're a genius. You figured this whole thing out. You've cracked the code. This is overconfidence, the deadliest sin of them all. On your next trade, you think, my usual position size is too small for a trader of my caliber. So you double it. You triple it. You ignore your risk management rules because rules are for beginners, and you, my friend, are a market wizard now. And that trade, the one you bet the farm on, is the one that goes to zero. The market has an infinite capacity to remain irrational longer than you can remain solvent, and it takes special pleasure in humbling those who believe they have tamed it. This is often tied to the gambler's fallacy, the belief that past events dictate future outcomes. After a string of wins, you feel you're on a hot streak and can't lose. Or after a string of losses, you feel you're due for a win. The market doesn't know you're due. Every single trade is an independent event with its own set of probabilities. Underpinning all of these biases is the most insidious mechanism of all, the dopamine loop. Every time you see a flash of green on your screen, every time you close a trade for a profit, every time you get a price alert notification on your phone, your brain releases a small hit of dopamine, the pleasure chemical. It's the same chemical released when you eat your favorite food, win a video game, or get a like on social media. Crypto exchanges know this. Their apps are not designed like boring financial software. They are designed like slot machines. The flashing colors, the satisfying cha-ching sound effects, the constant up and down movement. It's all engineered to keep you hooked, to keep you clicking, to keep you chasing that next dopamine hit. You stop trading a strategy and you start pulling a lever. You're not investing anymore. You're gambling. And just like in a casino, the house always has the edge. They don't need you to win. They just need you to keep playing. So you're fighting FOMO, loss aversion, confirmation bias, and overconfidence, all while your brain is being flooded with the same addictive chemical that drives a gambling habit. You are fundamentally, biologically hardwired to fail at this. So if our own brains are rigged against us, how do the pros overcome this? How do they turn this fundamental human weakness into a weapon? It comes down to a concept most beginners completely ignore, but it's the one thing that separates the 90% who fail from the 10% who survive. It's not about predicting the future. It's about managing the present. This isn't about charts or indicators or some secret algorithm. It's about building a system, a set of non-negotiable rules that act as a firewall between your money and your emotions. It's called risk management. And if you think that sounds boring, I promise you, it is infinitely less boring than watching your entire account evaporate in a single afternoon. The first and most important rule of this system is so simple, yet so profoundly powerful, that 99% of beginners either don't know it or willfully ignore it because it clashes with their dream of buying a Lamborghini next week. It's called position sizing. Position sizing has nothing to do with predicting if Bitcoin will go up or down. It's about answering one question before you ever click the buy button. How much of my account am I willing to lose on this one single trade if I am completely, utterly, catastrophically wrong? The professional standard, the one that has kept traders in the game for decades, is the 1% rule. You never, under any circumstances, risk more than 1% of your total trading capital on a single trade. Let's make this real. Say you have a $10,000 trading account. The 1% rule means the absolute maximum you can lose on any one trade is $100. That's it. Now a beginner hears this and thinks, $100? I'm trying to make life-changing money. How can I do that risking $100 at a time? And that right there, that single thought is why they are destined to fail. They're still thinking like a gambler at a slot machine, pulling the lever and hoping for a jackpot. A professional thinks like a casino owner. They aren't focused on any single hand. They're focused on the statistical edge that plays out over thousands of hands. The 1% rule is your statistical edge for survival. Think about the psychological power of this. If you risk 50% of your account on one trade and it goes against you, you're now in a massive hole. You're panicked. You're desperate. You're angry. You immediately start revenge trading, trying to win it back with even bigger, more reckless trades. You're emotionally compromised. You're finished. But if you follow the 1% rule, you make a trade, it goes against you, you lose $100. Your account is now at $9,900. Does it sting? A little. But are you panicked? Are you desperate? No, you're fine. You can be wrong 10 times in a row, and you still only lost 10% of your capital. You still have 90% of your ammo left. You have the emotional and financial stability to stay calm, analyze what went wrong, and wait for the next high-quality setup. This rule doesn't just protect your money. It protects your mind, which is your most valuable asset in this game. So how do you actually enforce this? This brings us to the second pillar of risk management, the non-negotiable stop-loss order. A stop-loss is a preset order you place with your exchange to automatically sell your position if the price drops to a certain level. It is your emergency eject button. Trading crypto without a hard stop loss is like flying a fighter jet without an ejection seat. It might be fine for a while, but when things go bad, they go catastrophically bad. Here's how position sizing and stop losses work together. It's the math that beginners run from, but pros build their careers on. Let's go back to your $10,000 account. You've decided to risk 1%, which is $100. You see a setup you like. You want to buy a token that's currently trading at $10. You analyze the chart and decide that if the price drops to $9.50, your trade idea is proven wrong and you need to get out. That 50-cent drop is your line in the sand. That's where your stop loss goes. So the distance between your entry price, $10, and your stop loss price, $9.50, is 50 cents. This represents your risk per share, or per token. Now you take your total allowed risk for the trade, $100, and you divide it by your risk per token, 50 cents. $100 divided by 50 cents equals 200. 200. That's your position size. It means you are authorized by your own system to buy 200 tokens. If you buy 200 tokens at $10, that's a $2,000 position. If the price then drops to your stop loss at $9.50, you lose 50 cents on each of your 200 tokens. 50 cents times 200 is $100. You've lost exactly what you planned to risk. 1%. You executed your plan perfectly, even though the trade was a loser. This is the process. This is the discipline. You don't just randomly buy $5,000 worth of a coin because you have a good feeling. You let the math dictate your position size. This mechanical process completely removes the greed and the guesswork. But I know what you're thinking. What if the price just wicks down for a second, hits my stop loss, and then immediately skyrockets without me? I'll miss out on all the gains. Yes, that will happen. It is a guaranteed cost of doing business. But you are asking the wrong question. The right question is, what if the price doesn't wick down and come back up? What if that small dip is the beginning of a 70% crash driven by a surprise SEC lawsuit or a hack? What happens to my account then? Your stop loss isn't there to guarantee a perfect exit. It's there to protect you from ruin. It's the insurance premium you pay to stay in the game. Accepting the occasional small loss from a premature stopout is infinitely better than suffering one catastrophic loss that ends your career. Okay, so you're sizing your positions correctly, and you're using a stop loss on every trade. You've built your defense. But this only ensures you don't lose too much. How do you actually make money? This leads to the third and final pillar of our system, the risk-to-reward ratio. Before you enter any trade, you must have not only a point where you'll admit you're wrong, your stop loss, but also a realistic target for where you'll take profit. The relationship between these two is your risk-reward ratio. And the secret is, you should only take trades where your potential reward is significantly greater than your risk. A common minimum standard is a 1-to-2 risk-reward ratio. This means for every $1 you are risking, you are realistically aiming to make at least $2 in profit. A 1-to-3 ratio is even better. Let's revisit our trade. You risked $100. A 1-to-3 risk-reward ratio means your profit target should be at least $300. If you can't look at the chart and identify a plausible scenario where the price could rise enough to net you $300, you simply don't take the trade. You pass. You wait. This is the concept that truly separates the amateur from the professional. Because when you strictly take trades with a favorable risk-reward ratio, something amazing happens. You don't have to be right most of the time. Let's do the math. Say you make 10 trades. You're using a 1-to-3 risk-reward ratio, risking $100 to make $300 on each trade. And let's say you're a pretty mediocre trader. You're wrong 60% of the time. 6 of your trades hit their stop loss. You lose $100 on each. That's a $600 loss. But 4 of your trades hit their profit target. You make $300 on each. That's a $1,200 gain. So after 10 trades where you were wrong more often than you were right, what's your net result? You're up $600. This should be a lightning bolt moment. Successful trading is not about having a crystal ball. It's not about being right all the time. It's about ensuring that your wins are mathematically larger than your losses. By combining disciplined position sizing, non-negotiable stop losses, and a favorable risk-reward ratio, you can be wrong most of the time and still be wildly profitable. You have turned trading from a guessing game into a statistical business. This isn't just theory. This is the mechanical, emotionless framework that allows traders to survive the insane volatility of the US crypto market. When news of a new inflation print hits, or a whale unloads their bags, the market doesn't care about your hopes or your gut feelings. It will obliterate the unprepared. This system is the armor you need to walk onto that battlefield. But having the best armor and a solid defense is only half the equation. It keeps you alive, but it doesn't tell you where to find the battle. It doesn't tell you when to strike. Now that you have your fortress of risk management built, how do you actually go on the offensive? How do you identify the setups that have a high probability of working in the first place? This is where we move from defense to offense, from survival to consistent profitability. And it all begins with understanding the two great warring philosophies that every trader must choose between. These two philosophies are technical analysis and fundamental analysis. Think of them as the chart reader versus the project detective. They are two completely different ways of looking at the market, and the one you choose will dictate every single decision you make as a day trader. Let's start with the one most people think they understand, fundamental analysis. The project detective, the fundamental analyst, is concerned with the why. They want to know the intrinsic value of a cryptocurrency. They dive deep. They read the white paper, that dense technical document that outlines what the project is supposed to do. They scrutinize the team behind it. Are they experienced? Do they have a criminal record? They analyze the tokenomics. How many coins are there? Is it inflationary or deflationary? Will a huge chunk be unlocked and dumped on the market next month? They live in the project's Discord and Telegram channels, gauging community sentiment. They look at the utility. Is this coin actually used for anything? Or is it just a speculative vehicle? For a stock investor, this is the gold standard. Warren Buffett is the world's most famous fundamental analyst. He doesn't care what the Apple stock chart did yesterday. He cares about iPhone sales, profit margins, and the company's long-term vision. And in the crypto world, for someone looking to invest for months or years, this approach makes sense. You're betting on the technology, the team, and the long-term adoption. But for a day trader, for someone operating on the 15-minute, the 5-minute, even the 1-minute chart, fundamental analysis is like trying to time your microwave using a sundial. It is the wrong tool for the job, and it's a mistake that costs beginners dearly. Here's why. Let's say you do your homework. You find a fantastic project, Project X. It has a brilliant team, revolutionary technology, and a huge partnership announcement coming tomorrow. You are fundamentally bullish. The announcement hits. It's even better than expected. The price starts rocketing up. The fundamental analyst in you says, buy. This is a great project. But the day trader has 1,000 questions that fundamentals can't answer. Where exactly do you buy? Do you buy right now, at the top of this green candle, driven by pure FOMO? Or do you wait for a pullback? If you wait, what if it never pulls back and you miss the whole move? If you buy now, what if this is the absolute peak and it immediately dumps? And even more importantly, when do you sell? Do you sell in 5 minutes for a quick scalp? Do you hold for an hour? Do you aim for a 10% gain or 20%? What if it goes up 5% and then starts crashing? Where is your stop loss? Fundamental analysis has zero answers for these questions. It tells you a project is good, but it gives you no framework for navigating the chaos of minute-to-minute price action. The market can remain irrational longer than you can remain solvent. A fundamentally great project can bleed value for weeks, while a worthless meme coin can pump 10,000% in a day. As a day trader, your job isn't to be right about the technology in the long run. Your job is to be right about where the price is going in the next 30 minutes. And for that, you need to speak the market's native language. That language is technical analysis. This brings us to the chart reader. The technical analyst operates on a single powerful belief. All known information, all hope, all fear, all greed, every fundamental data point, every news event, and every future expectation is already reflected in one thing: the price. The chart is the truth. Instead of reading white papers, they read charts. They see the battlefield of supply and demand playing out in real time. They aren't trying to predict the future with a crystal ball. They are identifying patterns in human psychology that have repeated themselves over and over again, in every market for centuries. They are dealing in probabilities, not certainties. Technical analysis is a vast world, but for a beginner, you only need to grasp a few core concepts to see its power. The first is price action. This is simply the movement of price over time, represented by those famous green and red candlesticks. Learning to read price action is like learning to read body language. You can tell when the market is confident and aggressive, when it's hesitant and fearful, or when it's tired and indecisive, just by looking at the shape and size of the candles. The second concept is the absolute bedrock of trading: support and resistance. Imagine the price is a rubber ball bouncing in a room. The floor is support. It's a price level where buyers have historically stepped in and pushed the price back up. The ceiling is resistance. It's a price level where sellers have historically taken over and pushed the price back down. As a day trader, these levels are your map. You look to buy near support because the probability is higher that the price will bounce up. You look to sell near resistance because the odds are it will be rejected. When the price finally breaks through the ceiling, resistance, that old ceiling often becomes the new floor, support. This simple concept alone can form the basis of a profitable trading strategy. The third concept is trends. Prices don't move randomly. They move in trends: uptrends, downtrends, and sideways ranges. An uptrend is a series of higher highs and higher lows. A downtrend is a series of lower highs and lower lows. The single most famous saying in trading is, "The trend is your friend." This means that it's far easier to make money by trading with the prevailing momentum than by trying to fight it. If a freight train is moving east, you don't stand on the tracks and try to push it west. You find a way to hop on board. Finally, you have indicators. These are the things that scare most beginners, all those squiggly lines on the screen like RSI, MACD, and moving averages. Here's the secret. They aren't magic. They are just mathematical calculations based on past price data. They are tools. They are like the gauges on your car's dashboard. They can give you useful information about momentum, trend strength, and overbought or oversold conditions. But you don't drive a car by staring at the speedometer and the fuel gauge. You drive by looking out the windshield. The windshield is price action. Indicators should only ever be used to confirm what the price action is already telling you, not as your primary reason for taking a trade. A beginner's biggest mistake is plastering their chart with 10 different indicators, looking for a magic signal, while ignoring the raw story the price itself is telling them. So why is technical analysis the undisputed king for day trading? Because it operates on the same timescale you do. It provides concrete, objective levels for entry, exit, and placing your stop loss. And most critically, it works because it's a self-fulfilling prophecy. When millions of traders around the world are all looking at the same chart, and they all see the price approaching a major support level, what do? They place buy orders there. And what does that flood of buy orders do? It causes the price to bounce, reinforcing the validity of the support level. You're not just trading a chart. You're trading the collective actions of everyone else who is also trading the chart. Now, does this mean you should completely ignore fundamentals? No. The smartest traders use a hybrid approach. They use fundamental analysis to create a watch list. They find coins that have high volume, a strong narrative, or a major upcoming catalyst, because these are the coins that are most likely to have clean, powerful moves. They use fundamentals to decide what to trade. But when it comes time to actually execute the trade, to click the buy or sell button, they switch hats entirely. They become pure technical analysts. They wait for the price to come to a predetermined level of support. They wait for a specific price action pattern to confirm their entry. They trade based on the chart, not the news story. They use technical analysis to decide when to trade. This is the professional mindset. Fundamentals give you the context. Technicals give you the execution plan. You find a fundamentally strong horse, but you wait for the technical starting gun to fire before you place your bet. You've now survived the market by mastering risk. You've chosen your weapon, the logical, probability-based framework of technical analysis. But a weapon is useless without a battle plan. A collection of concepts isn't a strategy. So, how do we combine support and resistance, trends, and price action into a simple, repeatable set of rules that actually tells you when to buy and when to sell? In the next part, we're going to build your very first, dead simple day trading strategy from the ground up. A complete system with clear entry and exit rules that you can take and start practicing with tomorrow. Alright, let's get our hands dirty. Remember, the goal here isn't to give you a secret magic formula that never loses. That doesn't exist. The goal is to show you the structure of a professional trading plan. It's a framework of logic, a set of rules you follow without emotion, so you can build discipline and consistency. This is your foundation. First, we need our tools. We're going to keep this incredibly simple. We'll use one chart time frame and 2 common indicators that you can find for free on any charting platform like TradingView. Our time frame will be the 15-minute chart. Why? Because the 1-minute chart is pure chaos for a beginner. It's just noise. The 4-hour chart is too slow for day trading. The 15-minute is a sweet spot. It gives you enough time to think and analyze, but the action happens fast enough to present opportunities within a single day. Next are indicators. We need a way to understand the trend and a way to measure momentum. For the trend, we'll use 2 exponential moving averages, or EMAs. Think of an EMA as a smoothed-out price line. It's just an average of the last X number of candles, but it gives more weight to the most recent prices, so it reacts a little faster than a simple moving average. We will use a fast 9-period EMA and a slower 21-period EMA. When the fast line is above the slow line, it suggests an uptrend. When it's below, it suggests a downtrend. It's our traffic light. Green means we look for buys, red means we look for sells. For momentum, we'll use the Relative Strength Index, or RSI. Don't let the name intimidate you. All it does is measure the speed and magnitude of recent price changes. It's displayed as an oscillator, a line graph that moves between 0 and 100. Generally, a reading above 70 is considered overbought, and a reading below 30 is oversold. We'll use this to help us avoid buying at the top or selling at the bottom. So we have our time frame 15-minute. And our indicators, the 9 EMA, the 21 EMA, and the RSI. Now let's build the rules. A strategy is nothing but a set of non-negotiable rules for entering and exiting a trade. Let's start with the rules for going long, meaning you're betting the price will go up. Rule number 1, the trend confirmation. This is the most important rule. We only look for long trades when the 9 EMA is above the 21 EMA. If it's not, we sit on our hands. We do not try to buy. This single rule will keep you from fighting the dominant trend, which is one of the biggest mistakes beginners make. We want to swim with the current, not against it. Rule number 2, the entry zone. Once our trend is confirmed, 9 is above 21, we don't just jump in. We wait for a discount. We wait for the price to pull back and touch our slower 21 EMA. This is our area of value, our buy zone. We're trying to buy on a dip in an established uptrend, not chase a rocket ship after it's already taken off. Rule number 3, the entry trigger. Just because the price touches our buy zone doesn't mean we automatically click buy. We need a final confirmation. We glance down at our RSI. We want to see that the RSI is not in the overbought territory. It should be below 70. This helps us avoid buying into a move that's already exhausted. So the trigger is, price touches the 21 EMA while the RSI is below 70. That's our green light to enter the trade. Now, the 2 most critical parts of any trade, the parts that actually manage your risk. Rule number 4, the stop loss. The moment you enter a trade, you must know where you're getting out if you're wrong. No exceptions. For this strategy, our stop loss will be placed just below the most recent swing low before our entry. A swing low is just the bottom of the most recent dip. By placing our stop there, we're saying, if the price breaks below this previous support level, my trade idea is invalid, and I accept my small predefined loss. This is your safety net. It's what protects you from a catastrophic loss. Rule number 5, the take profit. We also need a plan to get out when we're right. Greed is a killer. We're going to use a simple risk-to-reward ratio. We'll aim for a 1-to-2 risk-reward. Here's how it works. Measure the distance from your entry price to your stop-loss price. Let's say that's a 1% move. Your take-profit target will then be set at a 2% move above your entry price. If you're risking $50, you're aiming to make $100. This is non-negotiable. When the price hits your target, you close the trade and take your profit. You don't get greedy hoping for more. The system gave you a profitable trade. You say thank you and move on. Let's walk through a hypothetical example. You're watching Ethereum on the 15-minute chart. You see the 9 EMA cross above the 21 EMA. Rule number 1 is met. You are now a patient hunter, looking only for a long entry. The price rallies, then starts to pull back towards the moving averages. It comes down and kisses the 21 EMA perfectly. Rule number 2 is met. You instantly look at your RSI. It's at 52. Perfect. It's not overbought. Rule number 3 is met. You enter a long trade. You see the little V shape the price made before your entry, and you place your stop loss just below the bottom of that V. You calculate the distance. Let's say it's $30 of risk per coin. You immediately set your take profit target at $60 above your entry price. Now you do nothing. You let the trade play out. Your job as a decision maker is over. You let the market either hit your stop loss for a small, managed loss, or hit your take profit for a controlled, planned win. That's mechanical trading. Now, for going short, betting the price will go down, the rules are simply the exact opposite. Rule number 1. Trend the 9 EMA must be below the 21 EMA. Rule number 2. Entry zone, wait for the price to rally up and touch the 21 EMA. Rule number 3. Trigger, the RSI must not be oversold. It must be above 30. Rule number 4. Stop loss placed just above the most recent swing high. Rule number 5. Take profit set for a 1 to 2 risk-reward ratio to the downside. It's the same logic, just flipped upside down. Now, I need to be brutally honest with you. This strategy will fail. You will have losing trades. You might even have 5, 6, or 7 losing trades in a row. This is not a crystal ball. But that's not the point. The point of a system like this with a 1 to 2 risk-reward ratio is that you don't have to be right all the time to be profitable. Think about the math. If you make 10 trades and you lose 6 of them, that's a 60% loss rate. Sounds terrible, right? But wait, your 6 losses cost you $50 each, for a total loss of $300. Your 4 wins made you $100 each, for a total gain of $400. After 10 trades with more losers than winners, you're still up $100. That is your edge. That is how professional traders think. They don't focus on winning every trade. They focus on making sure their wins are bigger than their losses over time. So, what do you do with this system? You do not start trading real money with it tomorrow. Your first step is to become a scientist. Open up a chart, go back in time 6 months and manually backtest. Go candle by candle and apply these rules. Write down every single hypothetical trade. Was it a win? Was it a loss? What was the profit? What was the drawdown? Collect the data. See if the system actually has an edge on the crypto you want to trade. After you've backtested, you paper trade. You use a demo account with fake money, and you trade the system in real time for at least a month. This tests not only the system, but your ability to follow the rules without letting fear or greed take over. This is the hard work. This is the training montage. Most people want to skip this. Don't be most people. This system is a starting point, a template. As you gain experience, you might tweak it. Maybe you'll find a 10 and 30 EMA work better for you. Maybe you'll add a volume indicator for extra confirmation. You'll make it your own. But you have to start with a rigid, disciplined foundation. So now you have a complete system. Entry rules, exit rules, a way to manage the trend. But there's a fatal flaw we haven't addressed. A flaw so big it can bankrupt you even with a winning strategy. It has to do with how much money you put on the line for each and every trade. In the next part, we're going to talk about the single most important rule in all of trading, risk management. We'll calculate exactly how much of your account you should risk per trade to ensure you can survive the inevitable losing streaks and stay in the game long enough to be profitable. So let's get tactical. The rule is simple, yet it's the bedrock of every successful trading career. It's often called the 1% rule, and it states you should never risk more than 1% of your total trading capital on any single trade. Some professionals go up to 2%, but for a beginner in the volatile world of crypto, 1% is your lifeline. Now you might be thinking, 1%? That's it? I'm trying to make real money here, not pocket change. And that's exactly the mindset that blows up 90% of new accounts. Let me show you why with a story of 2 traders. Let's call them Alex and Ben. Both Alex and Ben start with a $10,000 trading account. They're using the exact same trading strategy, which has a 50% win rate, perfectly reasonable. The only difference is their risk management. Alex follows the 1% rule, risking $100 per trade. Ben, feeling more aggressive and wanting to get rich quick, decides to risk 10% of his account on every trade, which is $1,000. Now let's watch what happens when they both hit an inevitable and statistically common losing streak of just 10 trades in a row. Let's start with Ben, our 10% risk taker. On his first loss, his $10,000 account drops to $9,000. For his next trade, he's still risking 10%, but now it's 10% of $9,000, so he risks $900. He loses again. His account is now $8,100. Loss number 3. He risks $810. He loses. Account is now $7,290. Loss 4. He risks $729. He loses. Account is $6,561. By the 5th loss, he's already down almost 41% of his starting capital. The psychological pressure is immense. Every trade now feels like life or death. After 10 consecutive losses, do you know what's left of Ben's $10,000 account? A mere $3,000. $486. He has lost over 65% of his capital. To get back to his starting point of $10,000, he now needs to make a profit of over 186%. The hole he's dug is so deep, it's almost impossible to climb out of. He's emotionally wrecked and on the verge of quitting. Now let's look at Alex, our 1% rule follower. Alex starts with the same $10,000. He risks 1% or $100. His first loss brings his account to $9,900. His second loss, risking 1% of the new balance or $99, brings him to $9,801. His third loss is $98. His account is now $9,703. After the same 10 consecutive losses, do you know where Alex's account stands? $9,043. He's only down about 9.5%. Think about that. Same starting capital, same strategy, same unlucky streak. Ben is emotionally shattered and has lost almost 2/3 of his money. Alex is down less than 10%, feeling completely fine. He knows losing streaks happen. It's just a cost of doing business. He can sit down, reevaluate his strategy calmly, and continue trading tomorrow completely unfazed. Who do you think has the future in trading? This isn't just about math. It's about psychological survival. When you risk a huge chunk of your account, you are emotionally tied to the outcome of that trade. You'll watch the chart every second, your heart pounding. You'll make bad decisions like moving your stop loss further down because you feel it's going to turn around, or closing a winning trade way too early out of fear. When you risk only 1%, you achieve a state of professional detachment. The outcome of any single trade is irrelevant. You can focus on what actually matters, executing your strategy flawlessly over a large series of trades. You are no longer gambling, you are operating a system. So, how do you actually apply this 1% rule? This is where beginners get confused. It does not mean you just buy $100 worth of Bitcoin. That's not it at all. It's about calculating your position size based on where you are wrong. Let's walk through it step by step. Step 1. Know your account size. Let's stick with our $10,000 example. Step 2. Calculate your maximum dollar risk. 1% of $10,000 is $100. This is the absolute most money you are allowed to lose on the next trade. This number is non-negotiable. Step 3. Formulate your trade idea. This means identifying your entry price and, crucially, your stop-loss price. A stop-loss is a preset order that automatically sells your position if the price hits a certain level. It's your emergency exit. It's the point where you say, "My analysis was wrong, and I'm getting out before the loss gets any bigger." Never ever trade without a stop-loss. Let's say you want to buy Ethereum because you think it's going to go up. You decide to enter at $3,000. Based on your chart analysis, you determine that if the price drops to $2,950, your idea is clearly wrong. So your entry is $3,000, and your stop-loss is $2,950. Step 4. Calculate your risk per coin. This is simply the distance between your entry and your stop-loss. In our example, it's $3,000 minus $2,950, which equals $50. This means for every single coin of Ethereum you buy, you are risking $50. Step 5. Calculate your position size. This is the magic formula. You take your maximum dollar risk from step 2 and divide it by your risk per coin from step 4. So we take $100 and we divide it by $50. The answer is 2. This means for this specific trade setup, you are allowed to buy 2 Ethereum. If you buy 2 ETH at $3,000, your total position is worth $6,000. Now, if the trade goes against you and hits your stop loss at $29.50, you will lose $50 per coin. Since you have 2 coins, your total loss is exactly $100, your 1% risk. You see how that works? Your position size is determined by your stop loss, not by some random amount of money you feel like throwing at the market. A wider stop loss means a smaller position size. A tighter stop loss allows for a larger position size. But in every scenario, the total amount you stand to lose remains fixed at that $100. This is the single greatest secret to longevity in trading. It's not about finding the perfect indicator or a secret strategy. It's about ironclad defense. It ensures that no single trade, and not even a string of 10 bad trades, can ever take you out of the game. It allows you to survive the brutal learning curve and stay afloat long enough to actually become profitable. Every time you see a story online about someone YOLOing their life savings into a meme coin and making $1 million, understand that for every one of those, There are 10,000 untold stories of people who did the same thing and lost everything. They gambled and lost. Professionals do not gamble. They manage risk. They know that protecting their capital is job number one because without capital you can't trade at all. This discipline, this mathematical approach to risk, is what separates the hopeful amateurs from the profitable pros. It's the boring, unsexy foundation upon which all trading success is built. And before you even think about placing your first trade, you need to commit this process to memory and swear to never, ever break the rules. Because the market is relentless, and it will punish you without mercy the moment you do. So now you have the ultimate survival tool. You understand the taxes, the volatility, the scams, the psychological warfare, and the single most important rule for capital preservation. The picture is almost complete. The final piece of the puzzle is to take all this knowledge and forge it into a coherent plan of action. A checklist for your first days and weeks in the unforgiving crypto arena. So let's build that checklist. Your personal survival guide for the first 90 days. Think of this not as a set of rules, but as a system of armor you are building piece by piece before you ever step onto the battlefield. First, the foundation phase. This happens before you risk a single real dollar. Step 1 is deep education. And I don't mean watching a few hype videos. I mean you commit to at least 100 hours of focused learning. Read books on technical analysis, but more importantly, on market psychology and risk management. Find reputable sources, not paid influencers, who explain concepts like market structure, liquidity, and order flow. While you're learning, you're not just sitting there. You are paper trading. You will open a demo account on a platform like TradingView, and you will execute at least 200 trades based on the strategies you're learning. The goal here isn't to make fake money. It's to build muscle memory. It's to see your strategies fail over and over without any financial consequence. You're learning the mechanics of placing orders, setting stop losses, and seeing how price actually moves, not how you wish it would move. Step 2 in this foundation phase: capital assessment. This is a brutally honest conversation with yourself. You need to determine your total risk capital. This is money that, if it vanished tomorrow, would not change your life in any meaningful way. It won't affect your ability to pay rent, buy groceries, or sleep at night. For most people starting out, this number is a lot smaller than they think. Maybe it's $500. Maybe it's $1,000. It is absolutely not your emergency fund or your life savings. Once you have this number, you must truly accept that it could all be lost. This acceptance is your first psychological shield against making desperate, emotional decisions later. Step 3: platform and security setup. As a U.S. resident, you must use a reputable U.S.-regulated exchange. Do your due diligence. Look at their fee structures, their security history, and their customer support. Once you choose one, your first task is to lock it down. Set up two-factor authentication, preferably with an authenticator app, not just SMS. Set up address whitelisting, which means crypto can only be withdrawn to pre-approved addresses that you control. You are building a fortress for your capital before you even start trading. And the final critical step of the foundation phase, the tax plan. From day one, this is non-negotiable in the United States. The IRS treats crypto as property, and every single trade is a taxable event. Selling crypto for dollars, trading one crypto for another. It all generates a potential short-term capital gain or loss. If you wait until the end of the year to figure this out, you will be buried in an impossible mountain of paperwork. Sign up for a crypto tax software service from the very beginning. Connect your exchange via an API key. Let it track everything automatically. This single step will save you from a world of pain and potential legal trouble. Do not skip it. Only after you've completed this entire foundation phase, the education, the paper trading, the capital assessment, the secure setup, and the tax plan, are you ready to enter the proving ground. This is where you start trading with real but very small amounts of money. Your total risk capital? You're not using all of it. You're using maybe 10%. If your total risk capital was $1,000, you are funding your account with $100. This is your tuition. You expect to lose it. The goal is not to get rich. The goal is to see if you can follow a plan under real emotional pressure. And that brings us to the core of the proving ground, the written trading plan. If it is not written down, it does not exist. Your plan must have, at a minimum, 3 components for every trade. 1. Your entry criteria. What specific objective conditions must be met on the chart for you to enter a trade? Can't be a feeling. It has to be something you can point to, like a break and retest of the 50 period moving average on the 15-minute chart. 2. Your exit criteria for a loss. This is your stop loss. Where will you exit the trade if it goes against you? This must be determined before you enter. And it must be a hard stop loss order placed in the system, not a mental one you can talk yourself out of. And 3. Your exit criteria for a win. This is your take profit target. Where will you get out to realize your gains? This prevents you from getting greedy and watching a winning trade turn into a loser. Finally, during this phase, you will keep a detailed trading journal. Every single trade gets an entry. You'll log the asset, the entry price, the exit price, the profit or loss. But more importantly, you'll log your reasoning. Why did you take this trade? What was your emotional state? Were you calm and analytical? Or were you feeling impatient and forcing a trade? Were you following your plan to the letter? This journal is your coach. It will be the most valuable book you ever read about trading, because it's about the most unpredictable factor in your system. You. After a few months of this, of trading small, following your written plan, and journaling every decision, you will have a data set. You'll know if your strategy has an edge. You'll know your weaknesses. You'll know if you have the discipline to do this. And only then, after proving you can be consistent and disciplined with a small account, should you even consider slowly, gradually increasing your position sizes. But here's the final and most important piece of the puzzle. All the checklists, all the plans, all the strategies in the world are useless without mastering the final boss, your own mind. The market is a psychological battlefield designed to exploit every human weakness. When you're in a trade, your brain will be screaming at you. When a trade goes against you, fear will tell you to move your stop loss, to give it more room that it'll come back. That is your brain trying to avoid the pain of being wrong. When a trade is working, greed will tell you to cancel your take profit target, that this is the one that's going to the moon. FOMO, the fear of missing out, will tempt you to jump into a coin that's already up 50% without any of your entry criteria being met. And revenge trading after a loss will whisper that you need to make it back right now on the very next trade, usually by doubling your size. Every one of these emotions is a direct path to ruin. Success in day trading isn't about brilliant predictions. It's about relentless, boring, monotonous discipline. It's about executing your proven plan day in and day out like a robot. It's about accepting that you will be wrong frequently, and that taking a small planned loss is just a business expense. It's about understanding that 1 or 2 big wins don't make you a genius, and a string of losses doesn't make you a failure. It's all just data. So, the risk of day trading crypto in the USA isn't just that you'll lose your money. The real risk is that you will try to do it without a professional, disciplined approach. The risk is that you'll treat it like a casino, bringing hope and adrenaline to a game that only rewards cold, calculated execution. This is not a get-rich-quick scheme. It is, for the tiny few who succeed, one of the most demanding professions on earth. It will test your patience, your discipline, and your emotional fortitude in ways you cannot imagine. But if you approach it with the respect it deserves, if you build your armor, follow your plan, and master your own psychology, you give yourself a fighting chance. You transform from a gambler into a calculated risk manager. The market doesn't care about your story, your dreams, or how much you need the money. It is a relentless machine of probabilities. Your only job is to put the odds, however slightly, in your favor, and then execute flawlessly. The journey is brutal, but the first step isn't placing a trade. It's deciding what kind of participant you are going to be, a gambler or a professional. The choice is yours.